Today, we are diving straight in to dissect the brutal, often completely hidden truths of financial markets. We're going to tear down those illusions that most retail traders operate under, drawing directly from the deep insights of veteran trader Ali Sajidafar. Listen, if you think trading is just about finding the right pattern on a chart, you are in for a serious wake-up call. We're going to explore what actually moves the market, the psychological traps waiting to literally destroy your portfolio, and the mindset you need to actually survive.
Okay, let's dive into this with a quote that might sting a little. All trading styles are themselves the cause of traders getting stopped out, right? That idea completely shatters the illusion that mechanical cheat codes on a chart are going to lead to success. Ollie argues that the very systems and styles you've been taught, the rigid formulas you rely on, are exactly what the market uses to hunt your stop losses. We're all conditioned to look for that perfect mechanical setup, but relying blindly on those setups is exactly what gets you wiped out.
Which brings us to Section 1, the trading illusion. So to understand why these foundational strategies are actually traps, we first need to completely redefine the core concept of trading. Look, it is not a guaranteed system of buying and selling based on some magic indicator. No, it is entirely the art of playing with measurable probabilities. Absolute certainty? It simply doesn't exist. If you enter a trade expecting a guaranteed outcome just because a textbook pattern appeared, well, you've already lost the mental game. It's really about measuring the likelihood of an event and managing your risk when the absolute unknown inevitably happens. And this brilliantly illustrates the massive divide between the amateur and the professional. On one side, you have retail traders just obsessed with mechanical data, right? Drawing trend lines, hunting for chart patterns, and reacting to inducements. But on the exact opposite side is the real market engine. Unseen liquidity, deep order books, and huge institutional money. Retail traders are playing on a completely different, honestly, lower-level field. Because that massive unseen liquidity is what actually drives the market, and trust me, it completely ignores your perfectly drawn trend line.
Moving right along to Section 2, what really moves markets?
So if our little lines on a screen aren't moving the market, let's uncover the invisible forces that actually dictate price action. Think of the market like a giant iceberg. Only about 20% of it is actually visible to us, the candles, the blocks, the patterns you see on your monitor. But the market really moves based on the massive 80% of unseen liquidity just lurking beneath the surface. While retail traders are viciously fighting over that tiny 20% of visible chart data, the massive institutional money is quietly navigating the 80% we can't even see, just shifting price from one pool of liquidity to the next.
This brings us to a really critical question. Why do those perfect textbook patterns suddenly fail? Why does a flawless breakout suddenly reverse and wipe you out? The answer is a concept called inducement. The market deliberately creates these beautiful, visible patterns for the sole purpose of trapping retail money. It induces you to buy or sell, creates a massive pool of liquidity from everyone's stop losses, and then, boom, the big money sweeps it up. Your pattern didn't fail. Actually, it did exactly what the market engineered it to do, which is trap you.
Now let's look at Section 3, the pragmatic trader. With the deck stacked so heavily against us, how do we actually survive this? Well, we have to adopt a deeply pragmatic mindset. Now, what's really interesting about this slide is that it proves copying another trader's exact strategy will almost always fail. The philosophy of pragmatism in trading means you can only truly rely on your own personal live market experience. You can't just copy-paste someone else's mechanical strategy, because doing so completely ignores your unique psychological makeup, your stress tolerance, and your financial background. Seriously, what makes one trader wildly successful will literally blow up another trader's account.
And this leads us to a highly controversial stance from Ali. Backtesting is a trap. Yes, you heard that right. Spending months backtesting compresses time and creates a massive sense of false confidence. Why? Because it entirely removes the crippling emotional weight of the live real-time markets. In a backtest, you can easily hold a trade through a nasty drawdown. But in the live market, when it's your actual savings on the line, your brain freezes. You simply cannot simulate the intense psychological pressure of the present moment with historical data.
Let's turn to Section 4, the Bitcoin crash lesson. Let's ground these abstract market mechanics in harsh reality through a deeply vulnerable anecdote from our source. Ali shared a crushing story of personal financial loss. For years, he poured his savings and hard work into Bitcoin, becoming deeply emotionally attached to the asset. Then, the COVID crash hit. Overnight, Bitcoin plummeted to the $3,000 range. Within 24 hours, he was completely liquidated. His entire life savings just wiped out. This extreme danger of emotional attachment to an asset almost forced him to quit trading forever.
It's a brutal, brutal reminder that the market doesn't care about your loyalty, and it certainly doesn't care about your dreams.
Which brings us to our final part, Section 5, Mastering the Emotional Flow. That devastating loss highlights the final, most crucial piece of the puzzle, rewiring how we handle psychological pressure. Because let's face it, the emotions will come whether you want them to or not. The biggest mistake you can make is trying to forcefully suppress those emotions. Suppressing them is like capping a volcano. It just leads to massive explosions later, like impulsively changing your stop losses, overtrading, and eventual ruin. True professionals don't eliminate emotions, they just observe them. They treat emotions like a flowing electric current. The light bulb is on, the current is flowing, but you don't let that electricity dictate your physical actions. You acknowledge the fear without actually letting it click the mouse.
So the crucial point is having a highly actionable protocol for when that panic hits mid-trade. Here is a literal lifesaver. Step 1, observe the emotion. Just acknowledge that you are terrified. Step 2, immediately take your hand off the mouse. Break that physical connection to the platform. Step 3, write the urge down on a piece of paper. Literally write, I have an overwhelming urge to move my stop loss right now. Doing this shifts your brain from emotional panic to logical observation, and it stops self-sabotage dead in its tracks.
There's also this fascinating cultural insight Ali points out. He mentions what he calls the Iranian trader's superpower. Living in a highly volatile economy where currency values and economic rules can literally shift overnight actually builds incredible mental reflexes. This constant environmental instability forces a very high level of adaptability and the ability to pivot instantly. And those are traits that, if channeled correctly, are massive advantages when dealing with the relentless uncertainty of financial markets.
Which leaves us with a powerful, lingering question to end on. Before you even think about placing your next trade, ask yourself honestly, are your lifestyle and your psychology actually prepared for the reality of the market? Are you truly equipped to handle the 80% unseen forces, the emotional electricity, and the absolute lack of certainty? Reflect on everything we've unpacked in this explainer today. The market is a mirror, and it will expose exactly who you are. Make sure you're ready for what reflects back.